Got a couple of friends here hanging out with us, don't we? We got Proud Supermanian here for the next hour. Julie Hyman as well with a very special guest today, Julie.
Yes, thanks so much, Dave. Appreciate it. We're talking about Cathie Wood. Her flagship ARC Innovation Fund, it's attracted more than $1 billion in net inflows this year, but that's even as the price of the fund has gone down quite a bit, over 60%. Recently, Cathie has been sounding the alarm and blaming the Federal Reserve for sending the economy into the U.S. economy into recession. Let's bring in Cathie right now, ARK Invest CEO and CIO. Great to see you, Cathie. Thank you so much for being here. And we've talked about the inflation picture and the Federal Reserve before. There was a piece in Bloomberg today where Robert Burgess said you might well be right that Powell and company are being too aggressive on rates and will send the U.S. into a recession. We've heard other strategists raise that alarm as well. Talk to us a little bit about that and what that means for your portfolio, if indeed that's the scenario.
Well, I do believe that the stock market, has been discounting this for a good part of this year. The market is in a bear market. So the equity market's not going to be surprised, and even the fixed income market's not going to be surprised. The yield curve, so the difference between the 2-year and the 10-year Treasury yield, is over 80 basis points, 0.8%. This has not happened since the 80s, the early 80s, when Chairman Volcker, was taking a sledgehammer to inflation, an inflation problem that had built up over 15 years. This inflation problem built up over 15 months. And instead of increasing interest rates twofold, 10 to 20%, which is what Volcker did, Chairman Powell has taken interest rates up 16-fold. Again, never seen that before. And I do believe that the surprises now are going to be on the low side of inflation expectations, dramatically so. We believe that inflation will drop below the Fed's 2% inflation rate sometime next year. And the pipeline is telling us that. Commodity prices, inventories, which are overwhelming and causing all kinds of discounts, and the bond market itself, whenever there's a yield curve inverted, it is saying, okay, growth is going to disappoint, or inflation is going to be lower than expected, or both.
And so does that mean then, Cathie, that we're not going to see, say, a terminal rate of 5% or above from the Fed?
I would be very surprised if we see anything like that. I think one of the most visible commodity prices out there, oil, despite a lot of potential support, can't get going. It peaked at $130 per barrel after Russia invaded Ukraine. It's now down to $74. And even with China opening up, we think, supposedly a support for oil prices, it can't rally. So I see you're putting up here 71.60, but that would be yet another proof point. So.
Yeah, and so are all the sales, I guess, that we're seeing when we go Christmas shopping, a lot of folks on a lot of items, Cathie, as we see that start to feed through. So again, if this scenario is correct, if we are going to see inflation start to come down more sharply than anticipated, if we do see the Fed then slow down interest rates or even stop raising interest rates earlier than anticipated, bring it back to your portfolio and what that means for where you're investing.
Well, if you look at what has outperformed in the last year or so, we've seen the beneficiaries of inflation outperform. Now, I just told you that oil prices have come down from $130 to the low $70 range, almost cut in half. And yet the XLE, the S&P energy sector index, is not that far from all-time highs. So there's a bit of a disconnect there. And there we go. So what you will see as inflation unravels, interest rates come down, raising the present value of future cash flows, that kind of environment benefits our portfolio. We have stocks in our portfolio, companies that are going to be extremely profitable in the next 5 years. Right now, they may not be that profitable because they're investing aggressively to capitalize on some amazing opportunities in the genomic space, robotics, energy storage, artificial intelligence, blockchain technology. They're investing now because many of these are going to be winner take most markets. So they're huge markets. And therefore, there's latent profitability. The gross margins in our portfolio, so just taking a cost of goods sold from revenues, the gross margins are very high. And what they're spending on R&D, sales and marketing, stock-based compensation to attract talent in these early days is really important to their future success. So as interest rates come down, the present value of future cash flows going out 5 years, the present value of those increases.
Cathie, if I might, so you think interest rates are actually going to come down because the scenario that you were describing before, right, with the incredible increase that we've seen in rates already, even if the Fed doesn't get to 5%, even if it gets to 4.5%, right, and stays there, isn't that going to continue to be a headwind for some of these growth companies, some of which rely on lending, for example, on debt to do some of the investing you're talking about?
I think a change in rhetoric toward, hey, maybe we're not going up after 4.5%, or a change in rhetoric will get the market going. The market is trying to figure out how high is high. And you've got some observers, economists out there thinking it could be 6 or 7%. And so the market is holding back and saying, wait, we need some evidence. Now, I think the evidence is becoming very strong because long bond yields are down at 3.5%. The long bond market does not think interest rates are going to 5 or 6%. It's been moving in the opposite direction. We got up to 4.25 on the 10-year Treasury, and now we're down to 3.5%. So the bond market, I think, is speaking pretty loudly, and the bond market itself, which would be the most sensitive to rates going up, is moving in the other direction.
Cathie, we have to get to your performance because you could say the equity market is speaking as well when it comes to the performance that we've seen of your benchmark fund this year. ARK down more than 60%. And I know we've talked about this before, that you are a longer-term investor. But if you look back 3 years, you've underperformed the S&P 500. If you look back 5 years, you've underperformed the S&P 500. In fact, if you go all the way back to 2014 when you started the ARK fund, it still underperformed the market. So what catalysts can investors look for to turn that around? Is it going to be the interest rate scenario that you're describing?
Yes, we have never seen a market like this. This is worse than 08, 09. And I think many technicians basically took a chart of the tech and telecom bubble and the bust, and they said, okay, that's what's going to happen. That has happened to us and more. This is worse than the tech and telecom bust. The difference between the two periods is we got into an irrational market in the late 90s. Investors were piling on technology stocks, actually trying to outcompete indexes and each other. So they ended up with 40% technology, but the technologies were not ready. We didn't get cloud until 06. We didn't get breakthroughs in deep learning until 2012. Not only were the technologies not ready, the costs were way too high. To sequence the first whole human genome, it took $2.7 billion for one person's genome in 2003. Today, that's 500. The technologies are ready. The costs are low enough. The seeds for what we're investing now were planted during the 20 years that ended in the tech and telecom bubble. That was irrational. And I think we're on the flip side of the bubble right now. I think what's going on right now is irrational. Many of our stocks are below where they were at the low point in 2020 when COVID hit. Some of them are back to 2017 levels. And a company like Teladoc, its revenues are up 14-fold since. Its gross margins are in the high 60s, we think moving into the 70s. And that compares to the NASDAQ's 43% gross margins. See what I mean about latent profitability? They have a lot more to spend to make this backbone of the healthcare.
Well, Teladoc also still loses money, right?
This is what I'm getting back to. High gross margins, high 60s, low 70s. This company, its ultimate profitability is going to be superior because we believe it will become the healthcare information backbone of the United States, if not elsewhere. So just think about that. High 60s, low 70s gross margins compared to the NASDAQ, 43%. And yet the stock is selling for, I believe it's around 2 times revenues, whereas the NASDAQ is selling at 3.25. This is as irrational on the downside as the upside was in the late 90s. And the reason this has happened is because of the tech and telecom bust, and even more so, the 08-09 meltdown. Investors are scared to veer much away from their benchmarks. When we get into a risk-off period, they are selling any stock that's not in their benchmarks.
Well, I mean, in some cases, they're scared with good reason, right? I mean, because they've lost a lot of money.
Yeah, Julie, just one sec.
Sure.
So they, if I can just finish this thought, so that you understand, and so that your viewers understand. So they have been selling our stocks because they're not in the benchmarks. And it has reached an incredible level. But I also think if you ask where the risk is now in the market, I think it's in the benchmarks that everyone's crowded into because they're very backwards looking, and our portfolios are forward looking. Most people will not construct portfolios the way we do. They need their benchmarks. We need the best companies who are going to execute on the future of these 5 new platforms. And we believe those are in our portfolio. So if no other reason, given the down round we've been through, if for no other reason, we would be a great diversifier for those who are hewing to benchmarks where we think there's a lot of risk to the traditional world order because of innovation.
Cathie, I am curious. I was looking at your prospectus today, and it mandates that 65% of, again, RK be invested along the lines of what you're talking about, this innovative companies that you focus on. That leaves the other 35%. Was there any thought, I'm just curious, over the course of the year to get into other types of companies to sort of cushion the downside to some extent?
No, we know what we do, and our focus is completely on disruptive innovation. That's what I mean. Others will diversify into benchmark stocks. What we do, as they are selling our stocks, we are concentrating our portfolios on our highest conviction names. We've gone from 57, 58 names in the flagship portfolio to now 30 names. So that has what we have done is those which are the lowest on our scoring system have left. It's not like they won't come back into the portfolio, but we've concentrated towards our highest conviction names. I think the kiss of death for a strategy like ours is to style drift into another strategy. You will not find us buying energy at all. And why is that? Because the secular outlook for oil demand is down. We think that oil demand may have peaked in 2019. It's stretching to get back there now, but with electric vehicles taking off, and now you've got Uber and Lyft riders buying Teslas and other electric vehicles, the vehicle miles traveled, the electric vehicle miles traveled is increasing dramatically. And so we wouldn't touch energy. And I would say I'm proud of the call on energy after Russia invaded Ukraine. We looked at that price and we said, now surely there's going to be demand destruction and an accelerated shift towards electric vehicles.
Cathie, you said you don't style shift within your fund. You do have other products, of course. They're all along the same lines. And you did launch recently a new kind of fund, the ARK Venture Fund, which invests 70% in private companies, 30% in public companies. I'm just curious, what can we expect from you in 2023? Are you looking at any other sort of new products to bring to market?
Well, we do have two new crypto strategies, and yes, we're very excited about helping to democratize the venture space. $500 minimum requirement on the Titan app, so social distribution added to our social media and social marketing strategy. So very excited about that. And then two new crypto strategies. I believe the best time to launch new products is when times are tough and they're out of favor, because that gives the end investor an opportunity to ride the next wave. And, I really believe, if I can just back up and give you a sense, during COVID, as we learned the disaster that COVID would be, the market dropped in 1 month, roughly 30%, depending on the measure. We were down 46%. Our mantra back then was innovation solves problems. COVID's a terrible problem. And then, of course, our genomic revolution was our best performing fund, up 180% in 2020. But our flagship, from the low in April of 2020 to the peak in February of 21, went up 360%. And so this idea of innovation solves problems. We have more problems now. We have all the supply chain problems that innovation has helped work out. We have food and energy prices having increased as dramatically as they did. Electric vehicles, genetic engineering, CRISPR gene editing to allow crops to grow in less fertile areas than Ukraine. So innovation solves problems. And I believe what happened during COVID and after, as investors woke up to the idea that, wait a minute, innovation does solve problems. I believe that was a dry run for what we are going to experience during the next 5 to 10 years as these 5 innovation platforms around which we have centered our research take off. They are ready for prime time.
So I know we don't have much time left, Cathie, and I do want to ask you about crypto. You mentioned the 2 new crypto products that you're coming out with. I know you've been adding to positions in things like Coinbase and Grayscale. Whether or not crypto and the blockchain's innovation solves per problems, if the sentiment surrounding these new assets is bad and people don't want to buy them, to some extent, does it even matter if the technology is good or not, if people don't want to buy Bitcoin, for example?
Yes. Well, and first, before I answer that, I just want to say that these strategies are for advisors who do read our research, very sophisticated in their understanding, on the Eaglebrook platform. So that's really important to state. Mm-hmm. I think what we're learning because of FTX is how much more important fully transparent, decentralized networks will be to financial services going forward. FTX, Celsius, 3AC were all closed networks, opaque systems. You couldn't see what was going on. And what happened as they were going down, the people who were on the fully transparent distributed networks were able to get out scot-free. They saw what was going on. There were margin calls for those who were over-leveraged, but the system worked. It didn't skip a beat. Those other companies went out of business. It's a little bit like 0809. The old financial world is very opaque, not transparent. The new world that we're entering, and we do believe DeFi will actually get a boost coming out of this because it's so obvious now. Decentralized and transparent is the way to go. Those networks didn't skip a beat. All of the transactions were completed. And there are all kinds of metrics saying they're getting stronger now. It's very interesting to note that Sam Bankman-Fried who has either committed gross negligence or outright fraud, he didn't like Bitcoin. He didn't like it. And why didn't he like it? It's decentralized, it's fully transparent, and he couldn't control it. He was trying to control the crypto world, master of the universe. And that was a recipe for failure. It's been most unfortunate because so many people have been hurt because of it. But I do think the big lesson, and even the newest SEC commissioner is saying, you know what, we really have to double down on this idea of decentralization and transparency and help to propagate this new world with the right kind of regulation. And it's not like they have to change regulations. As Brian Armstrong says at Coinbase, we don't need new regulations. We need clear regulations. And we certainly need more clarity from Gary Gensler at the SEC. And the other thing we need, I would submit, is we would have saved a lot of people from some of the catastrophe that FTX has presented them with something like a Bitcoin ETF, a regulated. Instead, a lot of people went offshore and then got carried away with it. So I think the SEC deserves some blame for what has gone on as well.
Cathie, can I sneak in one more, or do you have to run? I know you have another meeting you have to get to.
Yes.
Okay.
Yes.
Okay. You do have to go?
No, one more. I do have to go.
Okay, great. I want to ask you about Tesla. I just want to sneak in one on Tesla, which you still have a big position in, right? Man, Elon Musk has been busy, as he always is. And there's new reporting today that his bankers are considering replacing some of the debt he used to buy Twitter with new margin loans backed by Tesla. There's also some reporting out of China that the production there is actually slowing down. Is your faith shaken in him at all in terms of running Tesla? Is there anything that would shake your faith in him in terms of how Tesla's doing?
So on Tesla, the end demand is the end demand. And in Shanghai, it does appear perhaps that high end demand is giving way to a little bit of low end from a pricing point of view demand because of the economy there. Yet in thinking about Tesla's positioning, now that supply chains have loosened up, I believe what's going to happen is Tesla is going to be at the forefront of being able to drive down costs and prices so that this idea of electric vehicles moving into the mass market is going to start to take root. Tesla is very aggressive at cutting costs and prices once we get out of this situation. So no, I'm not worried. In terms of manufacturing, which is the gating factor here, we need new plants as EV scale. We believe from 8.5 million units globally this year to perhaps 60 million in 2027. We think Tesla is going to be at the forefront of that. And so our conviction there has not diminished. Elon's main role at Tesla right now is moving it towards an autonomous taxi platform, which we think will happen in 2024. I think he thinks it'll happen next year. I think he is as focused as ever on that. And yes, he has had his hands full with Twitter. I think he's surrounding himself by the right engineers, and he's going to bring in new leadership. I notice, I don't know if this is going to be the case, but Brett Taylor, who just left Salesforce.com, was on the board of Twitter and certainly understands that company. He's an incredible operator. It'd be interesting to see him come in. I don't know if that's going to be the case at all, but I know he's going to surround himself by the right business leaders. He's not going to be running that company on a day-to-day
Cathie,
basis.
just to be clear, you think Brett Taylor would be a good choice as CEO of Twitter, is what you're saying?
When I saw him step down, now there are others stepping down as well, so maybe there's just an outright restructuring going on there. But I thought, he was on the Twitter board. Maybe, you never know. This is not even a rumor. I'm just saying he's the kind of person that I believe Elon Musk is attracted to and will surround himself at Twitter.
Interesting stuff, as always, thought-provoking. Cathie, thanks so much for the time. Really appreciate it. Cathie Wood of ARK Invest. Appreciate it. Be well.
All right. You as well. Thank you so much.
Now we're joined by someone who has her eyes on potential deflation. That, of course, is Cathie Wood, ARK Invest founder and CEO. And you recently wrote an open letter to the Fed where you warned about deflation. We talked to Michael Darda of MKM at the top of the show, where he said the Fed is making the mistake of looking at backward-looking indicators. What should the Fed be looking at, Cathie, when it's trying to really assess what is happening with inflation?
Sure. Hi, Julie and Brian. Well, if you look at what's happening in the pipeline, what you're seeing in terms of commodity prices are some very serious declines, both from their peaks and year over year now. So that is sort of, we would say that's upstream inflation that is heading towards the PPI and then ultimately the CPI. So we've got gold prices. And in fact, I looked at them yesterday. I had thought that the last 2 years, gold had been trading within the $1,700 to nearly $2,100 range. And that's true. It has, and it has broken down. This is a really good leading indicator of inflation. What caught my surprise yesterday was looking at where gold was in 2011, it was roughly this level. So you can say since 2011, more than 10 years, we haven't had a big burst, a big breakout in the gold price. And that is informing our decision here. Gold is a leading indicator of inflation, and it has not broken out. It is breaking down. And then the second thing that we're looking at is the inventory glut around the world, and especially in the United States. It looks like some of the best supply chain managed companies in the world have over-ordered. They ignored their automated enterprise resource planning systems, so ERP systems, and double-ordered, triple-ordered, so that Nike, for example, its sales were up only 3.5% globally last quarter, and yet its inventories were up 44%. And in the United States, they were up 68%. And if you look at in transit, they're up 85%. So that's just one indication. We're seeing lots of inventory overhangs, and even online sales are suffering. Amazon just had its second Prime Day, and it showed no increase, which is really from a year over year, which is telling us that either units are down or prices are down. So I think the CPI that we got today is a lagging indicator. It always is a lagging indicator. And we're seeing a lot of prices in the pipeline that are falling.
So, Cathie, let's talk about what this means for the Fed in your open letter to the Fed, where you urge them to consider some of what you're talking about right now. The market, after today's data, is now more fully pricing in not just a 75 basis point increase at this upcoming meeting, but at the one after that as well. Do you think the Fed should be done? Do you think they should even raise 75 basis points at this upcoming meeting? Or do you think they should stop here and give some time for their increases to make their way through the economy?
Yes, as we're thinking about this question, we compare what Chairman Powell is doing to what Chairman Volcker did in the late 70s, early 80s, when he was fighting an inflation problem that had been building for 15 years. Vietnam War, Great Society, closing the gold window. That was a real inflation problem that built up over 15 years. This inflation problem has been 12 to 15 months. By the time the Fed started addressing it. And we think it's much more a function of supply chain imbalances caused by COVID, and then again by Russia's invasion of Ukraine. These are very, very different circumstances. So what the Fed has done this time around is it has increased interest rates. If they go another 75 basis points, which is very likely on November 2nd, they will have increased interest rates from 0.25 to 4%. And that's a 16-fold increase. What did Volcker do? In the early 80s, he took interest rates from 10 to 20%. That's a twofold increase after consumers and businesses had gotten used to dealing with inflation and working around it over 15 years. This is a real shock to the system. And I do believe we will see the ramifications in many ways. We're seeing housing shutting down. And I think we're going to see a lot of other activities shutting down as well. We believe we're in a recession, and we believe this recession now will be sustained. And if we see an increase in GDP, it's probably because either inventories are continuing to increase or imports are coming down as companies try to unwind their inventories.
Cathie, so do you see a severe recession? And then how long do you think this bear market will continue?
Well, what's interesting, I think many people are coming around to the idea that we're in a recession or we're going into a recession. The first two quarters with real GDP growth negative to us means we're in a recession. And now that many people are worried and are beginning to see recession for as far as the eye can see, we are looking at this recession a little bit differently. We think it's going to be a function of this massive inventory overhang, and that it's going to be a serious inventory correction, but it's not going to be anything like we saw in 08, 09. That was a systemic financial problem caused by the mortgage and financial meltdown. We don't think this is the same thing. So now that many economists are starting to agree with us that we're in a recession or going into a recession, we feel that they might become a little bit too alarmist if this is just an inventory recession. And I think the Fed will have a lot to do with whether or not it is. This is a shock, though, to the system. And this idea that we have an inventory overhang, we think it's going to get bigger as consumers pull back, low saving rates, 3.5% versus 8% where it was before COVID. And so we'll see. We think this holiday season is going to be pretty tough.
And so as you kind of ready your shopping list for that holiday season, Cathie, when you think about some of the kind of ways that equity valuations are starting to price in that recession to the best of their ability, is there a big buy that you now kind of think through or evaluate going into the end of the year here?
Well, you have to consider the source here. Our focus, our sole focus, is on disruptive innovation. And we also believe that innovation solves problems. We had a tough time going into COVID with our kind of strategy. And then we had a boom in our strategy during COVID because guess what? We needed the genomic revolution to help sequence the coronavirus and figure out tests and vaccines. And our kinds of companies helped with that. We think with supply chain issues and with the food and energy prices caused by this shock, this Russia's invasion of Ukraine, that once again, innovation is going to help solve these problems. Electric vehicles, there's an accelerated consumer preference shift towards electric vehicles like Tesla because of oil prices. And we think there's no stopping that trend now. And in terms of food prices, we do believe that gene editing is going to help us figure out how to produce crops in areas that are less fertile than the Ukraine, the breadbasket of Europe, with less water, less fertilizer, less pesticide. So we're going to continue to see the miracles associated with the genomic revolution, but our other strategies as well, whether we're talking about robotics, solving the labor shortage, energy storage. I mentioned electric vehicles pulling us away from oil consumption, artificial intelligence, which is going to help every company become more competitive if they use their data and combine it with other data in effective ways. And then blockchain technologies, which is going to take the middlemen out of a lot of businesses and take the cost out of a lot of businesses, helping us to solve this inflation problem. So again, consider the source. We think innovation solves problems. It certainly gave us an appreciation of that during COVID. Our strategy was high flying, And we think we have even more problems right now. So stay tuned.
Cathie, this economic shock that you talk about in large part at the hands of the Fed, does that cause a shock to one of your long-term holdings in Tesla in terms of the stock price and also the company's financials?
Well, certainly all stocks are experiencing difficulty in this environment as the market tries to understand how far the Fed is going to go and how deep this recession is going to be. So Tesla, as I mentioned, is a solution to the problem. It's very interesting. If you look at gasoline demand this summer in the United States, it dropped below COVID levels, the worst of COVID, and it dropped to levels that we have not seen since 1997. That's real demand destruction. And it couldn't have happened, we do not believe, without electric vehicles at the margin taking huge share from traditional automobiles. So if we had to be concerned about an industry, it would be the traditional auto industry. We think that gas-powered vehicles are going to be obsolete within the next 5 to 10 years, and the traditional auto industry has to figure out a way to migrate into electric vehicles and into the next big phase, which we think Tesla is leading, the autonomous taxi platform phase. So lots of changes here. Traditional industries are in harm's way as innovation pushes through, accelerated by some of the turmoil out there.
Cathie, when we last talked back in the spring, I believe it was just at the beginning of the Elon Musk Twitter saga. Now we are maybe getting to a little bit of closure in that case. But I would pose to you the same question that I asked you then, because a lot of time has elapsed and different events have happened. Are you at all concerned about Musk's attention wavering now that it looks like he is, in fact, going to be taking over and likely at least having a pretty heavy hand in running Twitter?
Well, we are prolific users of Twitter. ARC gives away its research. We give away our research not when it's finished, but as it's evolving. And our most prolific platform, social platform out there, is Twitter. I'm kind of excited to see what Elon will do. I actually think he'll work closely with Jack Dorsey and maybe open up the ecosystem, take away the censorship, make it much more transparent, and I think add more value to that ecosystem.
You don't think that it'll be a mess if that happens? That it'll just be sort of a free-for-all where it's tougher to find commentary of value?
You know what's interesting about Twitter, and we found this, we have a lot of debate around ARC's own strategies. We can filter that debate ourselves. So we can unfollow people if we think there's bad behavior, but that's our choice. And we can follow those people who we think are moving discussions, whether it's about innovation or the economy, moving discussions along. So I think there's a lot of wisdom out there, and we're kind of sick of the nonsense that we see on some of these social platforms. And Twitter, I think, is going to give us more tools to filter out the nonsense and get right down to business.
I certainly would like to filter out a lot of the nonsense sometimes on there, Cathie. I want to ask you more broadly about ARK Invest and your funds. I was looking at ARK K in particular and the fund flows that we have seen, which we're seeing sort of bigger swings to the up and to the downside earlier in the year. They've gotten a little more muted as of late. You talk a lot about your 3 to 5 year time horizon, which yes, I think makes sense, but I wonder how patient investors are going to be, particularly in an environment where they're seeing losses, not just in ARK K, but in lots of other areas as well.
Yes, and I think one thing that helps our clients is our research, and they see that it's first principles research. We have the long-term time horizon, and we're seeing spectacular exponential growth opportunities. And not only one by one, the various platforms I just described, but the convergence of those platforms. So one S-curve feeding another. And I think many of our clients understand that they're short innovation, truly disruptive innovation. If you own the NASDAQ or the NASDAQ 100 right now, and you look through that index, this is not the index that I grew up with. In the 80s and 90s, when we were looking for innovation, we'd go to the NASDAQ. But if you look through the NASDAQ now, and especially the NASDAQ 100, what you see are 25% of the names touching disruptive innovation. The rest of them are kind of me too. They look like other indexes, the FANGs, Microsoft, NVIDIA. Tesla would be our only overlap. And then you look further and more deeply into these indices, and you see names that you'd never expect to be there. Food and beverage, utilities, rails, brick and mortar retail. These are not innovation companies. And so what we've done at ARC is we are pure play innovation. And we'd like to think we are what the NASDAQ used to be in the 80s and 90s. And it used to be a very productive place to invest with a long-term investment time horizon. So I think our sharing our research and our pointing out to investors, look, what you think you own in innovation is not what it used to be. And what ARC is doing is really back to the future. We're all about investing in the future as opposed to indexes, which are more about past success. Those companies that have been extremely successful have risen to the top of these indexes. But if we're right, in these 5 platforms that involve 14 different technologies are going to disrupt the traditional world order, then investors need to get to the right side of change. And one of the other things that we do, it's one of our missions and values, is to educate. That's why we give our research away. And we want to educate not only investors, but parents and grandparents about how the world is changing, how radically it's changing, and how it's ever more important to get especially students on the right side of change so that they can enjoy these incredible growth opportunities and not be disrupted by industries that will be sunsetting, shall I say.
Cathie, a 3 to 5 year time horizon means not only kind of midterm or recession proofing your companies, you're not just recession proofing your portfolio, you're also kind of midterm proofing your portfolio. You're general election proofing your portfolio. And so, at ARC, how do you go about identifying disruptive innovation that then doesn't get disrupted by public policy or political agenda?
Well, we have a 6-metric scoring system, very much focused on innovation. One of the scores is thesis risk. Thesis risk has a lot to do with government policy. And so in the early days of ARC in 2014-15, we were thinking, okay, government may be very concerned about the safety of autonomous vehicles. But as we've moved through these last 8 years, what we've seen, thankfully, is the government and regulators in particular very focused on data. And what does the data say? The data says that most fatalities and accidents, 85, almost 90% of them, are caused by human error. If we take the human being out of the equation, then we're going to save up to 35, 40,000 lives in the United States, the fatalities per year, and up to 1.25 million around the world. So that is a noble goal. And we've been very gratified to see the regulators looking at the fatalities in Tesla's vehicles and informing us that for the most part, most of those fatalities were caused by human error. And for the second, that people who are driving Tesla vehicles are much safer thanks to the various automated driving capabilities now, up to 40% safer than in most other cars. So we're very focused on what governments are studying in terms of the data. And if they stick to the data, innovation typically it solves problems and makes the world a better place.
Really, always a treat to get some time with you. Cathie Wood, ARK Invest founder and CEO. Always nice to see you. We'll talk to you soon. Appreciate the time.
Ryan, Julie as well. Thank you.
Thank you.
Cathie Wood of ARK Invest, thank you so much for being here. This is
Thank you,
great.
Julie. I'm happy to be here.
So I'd like to start with sort of what's in the news first, if we might, and specifically Twitter.
Yes.
I did see in your holdings, if I'm not mistaken, in your benchmark fund, you don't own Twitter anymore. First of all, tell me if that's correct, and if it is correct.
That is correct. So our flagship fund, we don't own any Twitter. And we've started moving out of most of the social platforms because there's a lot of competition out there, number one. I think Meta platforms, so Facebook, the sharp deceleration in its revenue growth to somewhere we think or their guidance was 3 to 11% for the first quarter. That was shocking and really brought to light TikTok is taking a lot of oxygen out of the room. And Twitter also, I would say the management change was another reason for us. Whenever we see big management changes, typically we're going to expect, this new executive, even though he was the CTO, kind of putting his own mark on the platform. And so that causes some uncertainty. And I feel like Jack's leadership was very important to evolving Twitter to where it was. And his idea of even opening up to sort of crowdsource the oversight of the behavior on the platform, we thought that was moving in the right direction. And Parag's first few things we saw after his arrival was more censorship. So, one thing after another.
Speaking of crowdsourcing about Twitter, Elon Musk, of course, with his back and forth, but he's been doing some crowdsourcing, right? He did some various polls on Twitter asking if there should be an edit button, etc. But what do you make of his back and forth, right? He took the stake in Twitter, was going to be on the board. Then they said, never mind, he's not going to be on the board. What does that tell you about both Elon Musk, but also about Twitter?
Well, it probably tells us more about the regulatory environment. It could be that Elon wants the freedom to, speak freely about Twitter and how he thinks it should evolve. And as a director, he might actually be hamstrung. I think that's the primary reason. We don't know the real reason, but I would imagine that's top of mind.
Is there anything that would get you back into that stock or into social media more broadly?
Well, one of the reasons we did hold Twitter is we thought because of its verification roots, that it would be a good platform for NFT verification. And they've talked about it to some extent. If we saw Twitter insinuating itself into that world aggressively, we might become more interested. But I am interested in seeing how they do evolve the platform. Should it be a subscription service as opposed to advertising, taking away, advertiser fears that they're going to be put next to some content they don't want to be associated with. Subscription, that would be a huge transition. Might be interesting, though.
And switching away from Twitter, more focused on Elon Musk for
Yes.
a moment, because obviously you have been a Tesla supporter for a long time, and I guess by proxy, an Elon Musk supporter for a long time. I'm always fascinated by Musk the troll versus Musk the innovator and leader, because both of those obviously are part of him, his sort of trolling affect on Twitter, etc. Is there a point at which it tips too much and it starts to concern you as an investor?
So we've thought carefully about this, and when it comes down to Tesla, the stock, the company and the stock, we pay a lot of attention to its barriers to entry. And as long as we see those moving up, and they are moving up, whether you're talking about battery technology, it's going to take a long time to catch Tesla. And what I mean by that is the traditional automakers. It's the only company with an AI that has designed its own AI chip for autonomous driving, taking a leaf from Apple's book. Apple was the only company to design a chip for a smartphone, a computer in our pockets or pocketbooks, and change the game. We think autonomous will change the game. And in terms of artificial intelligence, critical to success is high quality data. And it has more data, orders of magnitude more data than all of the auto and technology companies combined going after this space.
I mean, it's interesting to me because in some other industries, you've sort of sprinkled your holdings around, right? In some of the in the crypto space, or for example, or in the online brokerages I think of. But in EVs, less so. You're in Tesla. I believe you're in NIO and XPeng to some extent as well. Do you think that, as you say, Tesla's so far out ahead, but do you think it's also sort of more of a zero-sum game in EVs, that Tesla's just going to be so dominant for so long that the others are not going to be able to catch up?
Well, I do think from a cost point of view, its vertical integration has given it a tremendous advantage relative to other companies who are used to outsourcing everything. And so in terms of the winner take most, that's not as much about EVs, it's about autonomous, because that is a winner take most opportunity. And so the company with the best AI expertise and the largest bodies of high quality data and the domain expertise associated with battery technology, because autonomous will be electric, the electric transportation future. I think those companies are going to win, and there aren't going to be many of them. Our confidence is highest in Tesla. But I must say, I joined our analysts and went out to GM to meet with a full day of meetings with Mary Barra and her extended team. We have one more meeting with Cruise, which is, of course, in San Francisco. But I'm fascinated by how Mary Barra is really turning that ship around, and very focused on cruise automation and leaving it alone. Now Kyle, the founder, is back as leader, and watching them make San Francisco autonomous work. So now we get the question, autonomous, that's never going to happen. Well, it has. Cruise automation is in San Francisco, which is a complicated city, and they're making it work. Waymo has done the same, but in a less crowded situation in Arizona. I'm really impressed with Cruise, so we're taking a close look at that as well.
And I think there was just a viral video of police pulling over an autonomously driven vehicle. Does that mean you're considering investing in General Motors?
We have an open mind, and one thing we have to be careful not to do, we must not have a closed mind. And when we see success, we have to acknowledge it and learn a lot more about it. So we're still on a fact-finding mission.
I want to come back to NIO and XPeng too, because what's your view of those? I mean, obviously they're mostly still in China. They've been, NIO in particular, or I think XPeng in particular, has been trying to expand outside. Are they going to be bigger players? What's your thinking on them going forward?
So as we were pulling out of China largely, thinking about common prosperity, what does that mean? It means a couple of things. We think high margin companies are on the government's radar, and as this idea of common prosperity, cut your margins to increase access. So we're looking for very low margin companies, not normally what we look for.
That won't have big targets on their back.
Yes, that won't have, but are going to increase the access to transportation and autonomous. Both of them are going for autonomous now. Tesla, of course, is in China, but we would be surprised if the Chinese government wants Tesla to lead in the autonomous race. We know XPeng is patterning itself after Tesla, so that was our first buy. But NIO they're right in there, both of them. I think Neo on the design side is absolutely fabulous. So, and it's a little higher end. So we're kind of splitting our bets there, thinking that those will be the autonomous, one of those or two of them will be the autonomous champions.
We've been talking about some of the winners, Tesla in particular, but of course we have to acknowledge that RK has not had didn't have a great 2021, and the first quarter of this year wasn't so great either. I was looking at one analysis of your top 12 holdings that was looking at the average cost per share. And I think Tesla was the only one that is not underwater of those holdings. Does it, for lack of a better word, does it trouble you? Does it freak you out? How do you think about that when you're underperforming? How much stress this is that cause in the halls of ARK Invest?
Yes, I think you'd be shocked to see how calm and focused everyone is. We're focused on our research. Are we getting this right? We have a 5-year investment time horizon. So if you look at the last 5 years, including the first quarter waterfall performance, the last 5 years we have handily outperformed the NASDAQ, the S&P. So 5-year time horizon is not just looking back, but looking forward as well. And putting this recent performance into perspective, you'll note that during COVID, so from April, whenever the market bottomed, through February of 21, our flagship strategy was up almost 360%. No, I'm sorry. Yeah, 360%. Down 60% from that at our worst. Very tough. And, I'm thinking about our clients, and I've been extremely gratified, we all have, that for the most part they've stuck with us. Last year, our net inflows were $17 billion. Most of that weighted at the beginning of the year. And so they have felt the full force of this decline. And yet we inflowed last year, and we're inflowing this year. I think that has been shocking to a lot of our counterparts out there who have gone through periods like we've just experienced and have had massive outflows. And I think a few things are at work. Number one, our long-term time horizon is practically the first thing we say when we're talking to prospective investors. Number two, if I were to have told you in February, or talked to you in February of 21, even at that point in time, given our projections for the next 5 years, we expected our flagship strategy to deliver a 15% compound annual rate of return, so about double the market over time. Today, after this decline, our projections have, if anything, they've increased because artificial intelligence breakthroughs are moving so much faster than we expected. So our expectations for future returns have gone up as the prices have come down. So today, we expect, now consider the source. This is our research and these are our expectations, and we could be wrong. But whereas it was 15% last February, that number today is 50%. 50% at a compound annual rate. And it's because what we believe the market does not understand is we have entered the sweet spot of exponential growth trajectories. Most of the market thinks in linear terms. Most of our careers, we've experienced primarily linear growth, growth that slows down, decays to the nominal GDP growth rate over time. We have a few experiences with exponential growth. Amazon is a very big one. When we were buying Amazon in 2003, what we were saying to investors is, if you believed Amazon could grow anywhere in the 20 to 30% range for the next 20 years, would you buy it? You put that into a dividend discount model, you would buy that all day long. But that's not how people were thinking about it.
Well, and as you're talking, you effectively have to retrain investors, right? Investors over the past decade, 2 decades, have been trained to expect that pop, to expect short-term returns. how do you retrain them
Yes.
to focus more on the longer term, especially when there can be a lot of short-term pain?
Yes, yes. Well, I think the market is going to train them over time now. So over the last 20 years, as you say, the market has outperformed the majority of active investors, the vast majority. And so that is career risk for a lot of, so we've had now a lot of benchmark hugging because it's been the right place to be, the markets, right? The broad-based indices. If we're right on the amount of disruptive innovation that is going to disturb the traditional world order, the broad-based benchmarks are not going to be the place to be. Now, they'll always be tried and true. There are some stocks that are going to be able to weather all of the disruptive innovation that we see because they have great management teams. But so many companies in the broad-based benchmarks have gotten used to giving investors a little adrenaline with manufactured earnings, share buybacks, or increasing dividends. And they've leveraged up to do that, and they have not invested enough in innovation. For the kind of innovation to participate in it, in the innovation we see ahead, companies have to sacrifice short-term profitability and invest aggressively because we are in a lot of winner-take-most opportunities because of artificial intelligence. So if we're right, then in between now and 2030, this is in our big ideas on our website, between now and 2030, the market cap associated with truly disruptive innovation is going to move from $10 trillion today, which is less than 10% of the market, to 210 trillion. This is just in 8 years. So that's a 30 to 35% compound annual rate of return. And that kind of disruption to the traditional world order is going to mean subpar returns for the indexes, if we're right.
Right. I guess the question is sort of when does that start to happen, right? Because as you know, as somebody who's a markets veteran, you can be right all day long, but if the market doesn't think you're right,
then you're wrong.
Right, exactly. So,
for a period of
especially being in a rate hiking cycle, which has proven to be very challenging for many of these high growth companies, when are we going to see that catch up that you're describing?
Well, I think we started to see it during COVID. Innovation solves problems.
But we weren't in a rate hike cycle during COVID.
We weren't. In fact, quite the opposite.
Right.
Florida, the accelerator on fiscal and monetary policy. But in terms of igniting innovation trends or accelerating them, started back then. And because of tough comparisons with COVID, there's been a question. Is this really disruptive innovation, or are these stay-at-home stocks? We spend all of our time focused on disruptive innovation and making sure we're on the right horses, and we've spent the last year consolidating our flagship strategy from 58 names to 35 names. So these are our highest conviction names, and we've sold 22 stocks where we're saying, okay, maybe we don't have all the assumptions right. So we started during COVID, went through this, are these stay-at-home stocks or is this truly disruptive innovation? I think we're going to see a reacceleration of revenue growth. Now that we're moving away from the tougher comps, Zoom and Teladoc are two poster children for those, inviting a lot of questioning from that angle. And as far as the rate cycle, the interest rate cycle, if you look at history, and I actually had a value manager tell me this, who was cheering us on as, as a lot of people were not, shall I say. And he wrote, his client, and wrote an email saying, I have looked into this, and it is not your ilk of stock that gets hurt during interest rate hiking cycles. It is mature growth companies that experience most of the pain. Well, of course, we've had a lot of pain for a lot of reasons.
Right.
But we also have more problems. Russia, Ukraine, food, energy prices, we can help that. Our strategies are all about solving problems. Electric vehicles are going to help us move away from energy, right? Bitcoin mining as part of utility ecosystems is going to accelerate the shift towards renewables. And the genomic revolution is going to help us grow food in areas maybe away from Ukraine, as it's in quite a bit of turmoil, in other areas that are not as friendly environmentally to food production. So innovation solves problems. That's all we do. We've got a lot of problems, and inflation is another problem. We don't think it's going to be long lasting, but if it is, and if one of the reasons is a labor shortage, automation, artificial intelligence, robotics solves problems.
I got to come back to Zoom, though.
Okay.
Since you mentioned it. I mean, Zoom became so entrenched in our lives so quickly, it doesn't feel innovative anymore, right?
That's what's so interesting is.
So where does the next, how do we reignite, from your perspective, a growth at a company like Zoom?
So Zoom's user base went from 20 million pre-COVID to 200 million during COVID. Now, a lot of those were not paying users. In fact, paying users went down from 15% of the total to 3%. Now
because everyone was using it.
Yes, now we're back. But think about what a great marketing opportunity, as unfortunate as it was, what a great marketing opportunity COVID was for Zoom. We all know it. We've all used it. And I don't know about you, but I am relieved when I'm going to a video call and it's a Zoom call, not a Teams, not a WebEx, not a BlueJeans, because I always have trouble with those other ones. Anyway, this is the first rip and replace cycle in the enterprise communication space in 30 years. Cisco ignited the first one as we were building out the backbone of the internet. That was all on-prem, very physical, hardware-oriented, right? Zoom is in the cloud as a rip and replace cycle and is going to cut the costs of enterprise communications. Enterprise communications is the largest part of the tech stack, $1.5 trillion revenue opportunity per year. We think that there are two companies in the prime position to take us to the cloud when it comes to enterprise communications: Microsoft and Zoom. And it doesn't stop with you and me on a Zoom video call and everyone else we know. We are moving into Zoom rooms, Zoom events. We're moving into Zoom getting more involved with work processes. So think of, have you heard of Airtable and Monday? So really helping to evolve work processes as we move into the cloud and become more efficient enterprises.
I know you talked about this a lot last week at the Bitcoin conference, but I do want to ask you again about your Bitcoin $1 million call, especially as we see Bitcoin wavering again, dipping below 40,000. Time horizon matters, as we've been talking about. When are things going to get to $1 million? How long do
So that is a 2030,
like the other calls that you talked about,
right? It's somewhere between 2026 and 2030 is where we think that $1 million from $40,000. I don't think people believed me when I said it on stage last week at Bitcoin 2022, but I meant it. And many people think, okay, so you're assuming that institutional investors become huge holders of Bitcoin. No, we're not. We're assuming, though, that they will move in gradually, and by the time we hit $1 million plus, they will have a 2.5% exposure to Bitcoin. Now, this is such a big idea, and that is such a small allocation. I think they will regret not having more, because as I mentioned, this is the first, each word I'm about to say is really important. The first global, big idea, private, meaning not overseen by any government, digital, rules-based monetary system. It is a big idea, and my mentor, Art Laffer, when he was collaborating with us on our first white paper in 2015 on Bitcoin, he said, this is what I've been looking for, a rules-based monetary policy. It might not be the right rule, but it's a step in the right direction. And of course, he means by that it's a great store of value because it's mathematically metered to stop at 21 million units, so that's a quantity rule. So great store of value, scarcity meaning, but not a great means of exchange, right? That would mean a flat price rule. But we think over time, even that will, thanks to the Lightning Network, become more of a means of exchange and a unit of account, playing all three roles of money. And just to top this off, when Art and I and Chris Berniski at the time, our analysts, were collaborating, I remember saying, Art, how big could this be? This is amazing. And he said, well, how big is the U.S. monetary base? And back then it was $4.5 trillion, and Bitcoin was $6 billion in market cap. Today it's $800 billion. He said, well, $4.5 trillion. Today, that number is $9 trillion. So, it's a very big idea.
We're almost out of time, but I want to ask you a little bit of a reflective question to end us, because I think you are one of the hallmarks of Cathie Wood and ARK Invest in the brand is your conviction, right, in things that you believe in. But you also talked about earlier with regard to something like GM, keeping an open mind. So obviously you're reflective here on your process. What's the biggest mistake that you have made since you started the firm? Either a particular bet, a process, whatever you would pick.
You're talking from the investment side or running a business?
I would say either or.
Well, the heart and soul of the business is people. And I think in the early days, and this is for people who are starting companies up, founders of companies, I think every founder makes this mistake, and I tried to limit this particular mistake because I heard so many people talking about it. Be careful about the share of ownership that you give away to attract people. Be very careful. Make sure there's vesting involved. I made a few mistakes, not many, because I had talked to so many founders and said, if you could change anything, what would that be? And so I've been very careful with that. We're employee-owned and have one minority owner, Nikko Asset Management, in Japan. So I think the people is always the answer to that question. You make mistakes, and then you have to move on and make sure to cut losses as well.
And what about from an investment perspective?
The biggest mistake, let me just explain something or elaborate on something I said earlier. During risk-off periods, we cut the number of names in our portfolio, concentrate to our highest conviction names because we know there are mistakes in the portfolio. This particular strategy came out of making many mistakes in the past. And so whenever we go into a risk-off period, I say to all our analysts and to Brett Winton, our director of research, I say, okay, now is the time. We have doubts, and they're reflected in our scoring, but are they reflected strongly enough? Which names are we going to consolidate into? And the important other side of that is, which names are we going to consolidate out of? So I think doing that aggressively, we shall see. If we have concentrated towards names that really aren't truly disruptive, and we find that our research was faulty, okay, then that will have been a big mistake. But and in terms of the rest of our tenure, what happens when we sell stocks because, we've made a mistake. We try and remember, when we cut a score like that for management changes, let's have heightened sensitivity to the next management change because we should have sold the stock when there was that management change. And I know that there are names that we did sell for that reason, or that we did not sell for that reason, and those would have been some of the biggest mistakes. But, I've been in the business now for 45 years, and so I've tried to bring to ARC all of the lessons learned, and I've learned a lot of lessons. I've made a lot of mistakes over time, and so I'm not saying we don't make mistakes. I'm saying there are mistakes in the portfolio. If there aren't, then we're not taking enough risk. But during risk-off periods, many people would say, well, concentrating your portfolio during a risk-off period, that's risky. And we're saying, no, it's not. We're basically telling you we think we're not right in roughly 22 stocks, that our confidence isn't high enough. We're willing to let it go. And we do, like all of our stocks in the portfolio at any given time. But it is during the risk-off moments that we are very truthful to one another and say, yeah, this could become a problem, and I probably haven't cut my scoring enough to reflect it.
Very interesting.
Yeah.
Great to get some insight into your process and what you guys
Julie.
do. Kathy, thank you so much for doing this. Really appreciate it.
Thank you so much, Julie.
Thank you.
Okay.